QuickBooks Online 2025, the deposit form increasing the checking account. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for a result that has Intuit.com and the URL because Intuit is the owner of QuickBooks. I'm selecting the United States version of the software. You might have to, I'm going to close this first tab. You might have to verify that you're not a robot. So we are not a robot, although we crank out bookkeeping like a machine. Any case, we're in the sample company file, Craig's Design and Landscaping Services. Let's open up the major financial statement reports like we do every time. The reports on the left. In the Standards tab, Favorites. Right-click in the balance sheet to open a link in a new tab. Right-click in the profit and loss to open a link in a new tab. Let's tab to the right. Close the ham boogie. Change the time frame to 2 years. 01/01/24 tab 12/31/25 tab. Selecting the drop-down years. Run it to refresh it. We see 2024 and 25 side by side. Let's go to the tab to the right. Close up the ham boogie once again, changing the range into the same in 01/01/24 tab 12/31/25 tab, selecting the drop down years, run it to refresh it. We note that there's nothing currently in 2025 except for that $34, including prior presentation transactions we entered because we refreshed the data in the sample company file by logging out, logging back in. If you log out and log back in and it doesn't refresh, you might try opening it up in a different browser or in the incognito window. If you don't do that, you might have some transactions from the prior presentation, which might not mess you up too much as we move forward. Let's go to the first tab, selecting the drop down. We've been looking at the cycles within the cycles within the cycles. This time, the customer cycle, which could also be called the revenue cycle, the income cycle, the accounts receivable cycle. We want to look at the form this time of the deposit form, which is basic in concept. It's the form that's going to increase the checking account. However, it's a little bit more complex because the deposit form could be coming from different places and could be a result of different kind of revenue cycles. And so we want to kind of give another look at the different formats of the revenue cycle. You'll note that the deposit form isn't over here under the customer category, although I would primarily think of the deposit form as part of the customer cycle. Why? Because we hope that the money that's increasing our checking account is coming mainly from goods and services we provide to customers, and therefore is typically the end result of whatever kind of customer cycle that we have. However, I think QuickBooks puts it over here because we might have deposits from something other than customers, such as us, the owner, putting money in, or if it was a corporation, the issuance of the stock, the owners being the shareholders putting money in, or if we took out a loan and we made a deposit. So that's why maybe they put the deposits over here, even though we hope that mainly it's part of the customer cycle. Let's take a quick look at the flow chart again, just to remember how the deposits fit into it, noting this is the desktop flow chart, but it's just a flow chart, people. Don't get mad. We're on QuickBooks Online. We're just using the desktop. People, I have to say this every time because people get upset, like, why are you looking at the desktop? It's just a flow chart. The forms are going to be the same for just about any kind of accounting system. The flow will basically be the same. Okay, so we can see over here the deposits in the banking area, but it's clearly got an arrow going from the customer cycle over to that deposit form. And you can see no matter what kind of system we're using, the deposit form is typically the end process of any kind of revenue cycle. So quick review. The easiest revenue cycle is one where we have gig work or something. You get paid by YouTube. It goes directly into your checking account. You possibly use the bank feeds to record the revenue, which means that you're creating a deposit form from the bank feeds. Now we might lose a little bit of data because that deposit form is not designed to record revenue in QuickBooks. It's usually the sales receipt and the invoice that is designed to do that. But that might be the easiest thing to do. Or we might be at a cash register, in which case we would use a sales receipt form. That would be a cash-based system. but we can't normally just deposit the sales receipts into the checking account. We could, and that means this would be acting like a deposit form, but normally we don't, because if I collect revenue at the point in time that I make the sale and I collect like $105 transactions, when I physically go to the bank, I'm going to deposit it into the bank as one lump sum, not as $105 lump sums, which means it's going to hit the bank account in one lump sum. So when I record these sales receipts, I will typically put them into undeposited funds or some type of clearing account, which we'll talk more about in future presentations, and then deposit it into the bank account with a deposit form. And then I'd have to match that deposit form to what clears on the bank feeds. Or if we have a receivable situation, we have to send out an invoice, like a bookkeeping or landscaping. We do the work first. We send out the invoice. And then when we receive a payment on the invoice. If we receive a payment, or when we receive a payment, then we record the received payment. This received payment, like the sales receipt, we could put directly into the checking account, making this act in essence as a deposit form. But we might have the same situation. We might get paid through a credit card or cash or an intermediary platform, in which case I want to put it into that clearing account again, so that when I transfer it to the checking account, it'll be in the same format as on the bank statement, making it easy to reconcile, also allowing me to deal with any kind of bank charges by the third-party platforms or the third-party financial institution like a credit card or something like that. Now, note that, again, if you send out an invoice and you have like the QuickBooks checking account and you have this nice little link in the system and the invoice that pays it automatically through a QuickBooks checking account, then the system might be able to record these two basically automatically with that little process. But you would have to not only have bank feeds in that case, but have the QuickBooks banking. Otherwise, you're going to have to tell them to do a transfer with your third-party bank somehow, possibly with a link that way, and integrate the bank feeds. Okay. Now, the one other thing that could happen is you could get paid first, meaning they give you the money first. And normally, we'll talk more about this later, it's a more unusual transaction if you had that newspaper business or something where you get the money before you throw the newspaper through people's window, at which point you earn the money. So in that case, we typically record the received payment first, which actually records like a negative receivable because you didn't actually earn the money. So that's the weird one, because normally you get the deposit at the end of the time when you do the work. And you typically do the work at the same point in time you get paid, like in a restaurant or a food truck or any kind of store with a cash register, or you get paid after you do the work, like anytime you invoice somebody, but sometimes you get paid first, in which case the money goes in your checking account before you record the revenue. That's a little bit more unusual. Okay. And then we could also have a deposit for something other than from the customer, like we put money in to expand the business or we take out a loan. In those cases, we got to make sure that we don't record that deposit as revenue. All right. Let's go from easiest to more difficult. Let's think about a situation where we get paid by like gig work or something. In that case, the easiest thing to do would be saying, okay, I just work on YouTube or something and YouTube pays me and I'm just going to connect YouTube or whatever the platform is to my checking account, and then I'll pull in the bank feeds, and as they come through the bank feeds, I'll have these received payments. And if this was coming from, say, whatever the platform is, it's going to be a deposit type of form, right? And then I can say that it's going to come from, I might put the customer of Google. I would record it simply to a revenue account here and then record it. And I would record an increase to the revenue account with a deposit type of form. Let's try that. Let's put it into income. Let's say sales of product. Even though I didn't have a product, I'll just put it into that revenue account just to have a demo. And then I'm not going to put any product or service, and it would be from like Google. We could say we'll put a customer of Google. I need it here, Google, and save it. And this happened on 2/6. So I'm just going to save it and then go on over to my balance sheet, run it, and check out the checking account. It happened in 2024, right? So it was, or was it in 2025? Let me go back. It was 2/6. Yeah, it isn't. That's good. So there it is right there. So notice if I go into it now, I have the deposit recorded with a deposit form. So in other words, the bank feed made a deposit type of form, even though when I did the data input, it didn't really look like a deposit. We'll talk more about bank feeds later, but let's go back up. And then the other side, we put to revenue. So let's go to the income statement, run it. And then there it is. We put it right here. Here's the 55. Now, the thing that's funny here is now we had an increase in revenue with a deposit form, which is unusual unless you're in a type of business where that's the way you're going to format it. In other words, if I go back and I look at the revenue accounts like in last year, we're not going to see any deposit forms. We're only going to see invoices and sales receipts typically. So only if you're in a type of business where you can more simplify it, like gig work or something like that, could you use basically this kind of system. And that's one of the things you want to be considering as a bookkeeper in terms of what kind of clients do you want to be picking up and how you're going to set up your accounting system based on that. Now, if you have a system where all the deposits coming through, you're just going to record as revenue, then you also have to be careful and say, what if one of these deposits wasn't revenue? Meaning, what if you, the owner, transferred money from your personal account into the checking account, or you took out a loan? In those cases, if you recorded this and this was a loan or from you as revenue, you would record revenue incorrectly because it should be going to an increase to the checking account. The other side goes to an equity account. So if you were to record it in revenue, it would be bad in the United States for income taxes in particular because it would make your net income go up, in which case you would be paying taxes on it. You'd be paying taxes on something that wasn't actually revenue. It's money that you invested into the company. So if you put money in, what would happen? We would say it's an increase to the checking account, but the other side would be going to equity. If you were the one that put money in, which you might make another account called equity, or it might come from a loan, for example, a liability from the bank. We might take a look at those transactions a little bit more later, but let's go down to the standard transaction now. Now let's think about a situation where we have more of a full service system. So let's enter the invoice and then receive the payment. So let's do that. So let's say we enter an invoice, boom, first tab, invoice, and I'm just gonna, we've done this a few times, so I'll just do a generic invoice, customer one again, and then I'm just gonna add that, and I'm just gonna say, all right, 17, that's fine. And then down here, I'm just gonna say this is service item 1, which I misspelled again. I'm cool with that. Service item 1. It's gonna be a service type of item that I'm gonna set up. And service item 1. It's gonna go into the service revenue account. The price, let's make it a good old $100. Description, service item 1. Let's get rid of the sales tax for simplicity's sake. No sales tax. And then done. So it goes into the service income. All right, boom. So now we'll put in just the good old $100. So what's this gonna do? Increase accounts receivable. The other side is gonna go to income. So let's go ahead and save it. Let's go into our balance sheet. Okay, paso, I said save and send. Save and close. And then let's go to our balance sheet, run it to refresh it. And the accounts receivable now, we should have our transaction in the A to the R. It didn't refresh. Let me go back, refresh it again, and then go into it otra vez. There it is. There's the $100. The other side, I'm going to go back, go to the income statement, run it to refresh it. Other side, $100 right there. And the service revenue, that looks good. Let's go to the first tab now. and then we would have to collect on the payment. So once again, you could say, well, what if I wait till it clears the bank and then I see the bank feed past the bank feed, and then I could try to match that to the transaction. You could possibly do that. We'll talk more about those options later, but most likely you'd have to go into the sales transactions here, and then when you get the payment, however the payment is formatted, credit card, cash, check, and so on, we can go into the sales items and search for the invoice, or we can go into the invoice item and search for the open invoices. So we want the ones not due yet. So there's customer 1, or we can search it by the customer, and then we're going to receive payment. So remember, if I select the receive payment form, this form I could deposit directly into the checking account by selecting this and go, I want to put it directly into the checking account. If I did that, this form is acting like a deposit form. So I just want to look at the distinction between these two methods. So now I'm going to deposit this directly into the checking account. Let's check that out. Save and close, and then go into my balance sheet, run it to refresh it, and then go into the checking account, and you'll see that we have, let's go back again, refresh it, run it, refresh, dang it. You should have 2 in there. So now we have this payment form acting as a deposit. So that might be doable if you have a situation where the payment is going to be grouped in the same format as will clear the bank feed, so you can easily reconcile it. It does cause kind of a problem, though, because now we have an increase, which is kind of like a deposit, but it's not using a deposit form. It's using a payment form, which is a little wonky. All right, let's do the other method where we and the accounts receivable went down here. Let's do the next method. Let's enter 2 invoices, and that's when we usually would have to use the deposit form and take them out of the undeposited funds. Let me show you what I mean. Let's make 2 invoices this time. This is going to be for customer 2, let's say. Customer 2. And this will be on 718. And we'll make it service item again, but this time we'll have 2 of them. And so that's going to be 200, increase in accounts receivable, increasing revenue. And then I'm going to say save and new. And then we'll do it again, otra vez, and say, we're going to say customer 3 also had a service item, which we will set up on like 19, let's say. And then we had service item, and let's say we sold 3 of these this time, 300, increase in accounts receivable, increasing the revenue, save and new. I'll close it up because I don't want a new one actually. And then I'll go to the balance sheet. Let's check that out. Run it to refresh it. Que paso? What happened in the accounts receivable? It didn't pull over again. Let's go back. Run it to refresh it. Sometimes this online, the sample company file does this more than like the normal file. So there it is. So the 2 and the 3, that looks good. And the AR, I'm going to go back, and then in the P&L profit and loss tab and to the right, run it to refresh it. We now have the revenue of the 600. That makes sense. Let's go back. Let's go to the first tab. And this time, let's find the invoices by going to the customers, just to switch things up a bit, closing the ham boogie so we can boogie on a bigger dance floor. And then we're going to open the invoice, open invoice and credits. And we have customer 2. Let's go into that one. And let's say we receive a payment, receive the payment. So this time, I'm going to imagine that I'm going to get paid in some other way, such as with cash or say with a credit card or something. Let's say it was Visa paid us. So now I'm going to say, I'm not going to put it into the checking account. I'm going to put it into our undeposited funds so that I can group the money that's coming through the credit card, because it's not going to come in transaction by transaction. They're going to group some of them together, which I'm going to have to find some system to do on my end. Otherwise, the bank reconciliation will be a mess and I won't have good internal controls. So what's this going to do? It's going to increase the undeposited funds and decrease accounts receivable. Let's go save and close, or let's do save and new this time. Save and new, or save and send. I didn't want to send it. Let's save and new. That's what I wanted to do. And then this time I'll just type in customer 3. So I'll check this one off. And so once again, I'm going to say this came from the Visa. They paid us through Visa card. And we're going to say, okay, we got the payment, but we haven't deposited it yet. So we've got the invoice. And I'm going to say save and close. Save and close. And then if I go to my invoices, we've got paid on them, but they're not deposited yet. They're in undeposited funds. So these items are here that we receive, but they're in undeposited funds. And if I go to my balance sheet and run it to refresh it, then we have the undeposited funds has gone up. If I go into the undeposited funds, let's go back again and refresh it again. There should be 2 in there, shouldn't there? Refresh it again. Run it again. Otra vez. There it is. The 200 and the 300 are in undeposited funds. The other side decreased. The A to the R, the accounts receivable. Accounts receivable should have gone back down. So there's those. That looks correct. So now we're gonna make the deposit. So when I make the deposit, I'm going to go to the first tab. Now, the thing that's great about QuickBooks, it's nice, is if I hit the plus button and I go into a deposit type of form, bank deposit, the money that's in undeposited funds will be reflected here. The money that increases undeposited funds will always be either from an invoice that we have received payments from or the sales receipt, like if we're at a check register and we put that into undeposited funds. So you'll note that we have these transactions. These are the 2 we entered. These are the ones that were in there before. That adds up to a total of $2,562.52, which should tie out to the balance sheet and what's in undeposited funds, $2,562.52. So now if I go back on over here, I can group them together. So I'm going to put these 2 together and imagine that now the credit card company put them together as they actually physically put the money into my checking account. I'm going to mirror that transaction on our side so that I can match it out to what happens on the bank statement, which we might see in the bank feeds. So then if I go down, maybe there was a fee in it as well. So that would go into bank service charges. And we might say, well, what if they took out $5? Let's say $5 was removed. That means we only got $4.95, right? Because we deposited these 2, 500 minus $5. What's this going to do? Increase the checking account by the $4.95. It's going to decrease undeposited funds by the 500, and it's going to record a service charge of $5. Let's go ahead and save and close it and see if that is indeed what happens into the balance sheet. We're going to run it to refresh it, and if we go into the checking account, is it going to do it this time? There it is, $4.95. I think that's the one. If I go into that one, there we have it. Boom, boom, boom. And then I'm going to close that back out. And notice it went in here in one lump sum. This is the amount that we expect to hit the bank account, which we might see from the bank feeds, at which point we're not going to use the bank feeds to record something. We're simply going to use the bank feeds to verify that this has hit the bank correctly, thereby just having a bank reconciliation function for the bank feeds. Let's go back. The other side's going to be decreasing the undeposited funds. And notice on the undeposited funds side of things, it didn't do it with one lump sum transaction, but broke it out. And that's great because now I can tick and tie the increases and the decreases, the payments and the deposits, even though they got deposited at one time. It's in here with 2 deposit forms, which looks a little wonky. But if I go into it, both of those amounts are in the same deposit form or were checked off at the same time at the same form. Closing this back out, going back, the other side's on the income statement, which que paso to the income statement. Let's go back in here. What happened? We're going to go 010124. I'll just do it again. 123125. Some gremlin got in here and messed up my income statement. That's okay. That's okay. I have gremlins all the time around here. They don't bother me. They do bother me. I'm lying. They bother me. But I don't let it stop me. That's what I'm talking about. Anyways, there's the $5. All right, so then let's go to the first tab again. So those are the main functions of the deposit form. Now note that if you got a deposit that didn't go through undeposited funds, then you might not need to use like this deposit form. You might enter it another way, such as, for example, if we had the bank feeds and we just waited till they cleared the bank, as we saw before, we can wait till they clear the bank and record them here. You might use the register. So let's just check out the register. So I'm in the transactions, the chart of accounts. So let's imagine that we the owner are putting in a deposit to the bank. So to our checking account in the business. So in the checking account, we might go into the register here, which might make you give a feeling of the old check registers on a checkbook. And I can select the drop down and say I want a deposit type of form and just put in like the 12th, let's say. And then it might come from us, the owner, and I could just put owner deposit or something like that. And then we're going to make it like $500. So we're going to put the money in. If that was the case, we want to put it to some kind of equity account. So I'm going to make a new account just to show you. And the type of account, it would have to be an equity type of account, not income. If we put it into income, we're going to end up increasing our income statement. And if we're in the United States, paying taxes on it. So some kind of equity account, I'll put owner's equity just for now. I'll just say owner's contribution. So we're going to increase it there and say save and close. So it's going to increase this equity account. And if it was a corporation, by the way, it would be the issuance of stock would be the way that that the owners put money into the business. When you buy stock, that would mean you buy it from the company, not on the secondary market, which is where we normally trade stocks. So, but we won't get into that now. So let's save it and close it. And so now, if I go to my balance sheet for that one, we have to run it up top. And let's go into my checking account and see if that one came through. There's the 500 deposit form. If I go into the deposit form, notice it doesn't take me to the register, but it takes me to a deposit type form. I didn't check something off up top. I just recorded the account at this part at the bottom of the deposit form. Closing that back out, going back to the balance sheet. The other side did not go to revenue. That's the point here. It went to the equity section because we, the owner, put the money in. So that means from a balance sheet standpoint, what happened, assets went up, and then the other side was equity, but it didn't come through income, meaning equity is the amount of assets owed to us, the owner. So we put it directly into equity with an owner's contribution. We might talk more about that later in our practice problem. But one other way you might see a deposit is if it was a loan. So let's say we had a loan on like the 14th, came from the bank loan, and let's say this was $600, and it came from the bank. So I'm going to put it into loan payable. So it's going to go to loan payable, a liability, not income is the point. Let's save that. And then we're going to go to the balance sheet and then run it and check out the checking account. Otra vez again. Por favor, please. It didn't come through. Something happened. Let's go back and run it again. Refresh, dang it. Refresh. You should have a 600. There it is. There's the 600. If I go into that, there it is, our deposit form. It's at the bottom part of the deposit form. Boom. Close that back out. Going back the other side this time, didn't go to income, didn't go to equity, but rather went to liability for the loan payable. Loan payable right here. Boom. The $600 increase. Where, donde? It's not doing it. You're not doing it right. Let's refresh it again. What's wrong with you, QuickBooks? Getting slacking. Brain is going like Joe Biden's here, for crying out. Anyway. So, all right, there's the 600. Let's go back up. And so that's the general idea with the deposit. So with the checking account, remember that the deposits are going to be the form. If I go into the checking account here, all this detailed activity are happening in the checking account. Normally, the deposits are going to be the form that will increase the checking account. However, you could have two other forms that kind of act as the deposits depending on your accounting system, that being the payment form and the create sales receipts, if you're using a system that you're not putting that through undeposited funds, but directly hitting the checking account with these two forms. If that's the case, when you filter and sort by the deposit form, you have to make sure to pick up those forms, which could also be increases. The other thing that could be an increase to the checking account would be a bank transfer, like you transferred money in from the savings account, which was also a business account, to the checking account. In that case, you probably wouldn't use a deposit form, although you could, because the deposit form would be decreasing the other account. So we'll talk about the transfer forms later. But the checking account is the most common account to sort by transaction type. And so you want to know what transaction type forms are going to increase the checking account. That's usually just a deposit form, but could be those other forms, sales receipt, payment form in certain cases. And when you get a deposit form, if it's coming in from the from the bank feeds, and your system is just to record all deposits as revenue, we want to make sure that we pick up in some way the deposits that aren't revenue, those coming from us, the owner, or possibly from the bank. And usually it's kind of easy to do that because there'll be a nice round number oftentimes. But we want to make sure that we see that. Otherwise, most of the increases to the checking account, like we say, will be from the customer cycle in some way, shape, or form at the end of the cycle. Now, again, the one other way that we might have our customer cycle is we get paid first. And we'll talk more about that prepayment situation in the future because there's a couple different ways we can deal with that. You could enter the sales receipt first, which would record like a negative receivable kind of situation, which is a little wonky. And so I don't want to spend all our time kind of getting into that. So we'll touch in on that situation in a future presentation.